Ladies and gentlemen, welcome to Renaissance Capital's third MENA conference. Our first was in Cape Town, as we tried to explain the region to as many investors and in South Africa as we possibly could. The second one is in Marrakesh, and the third, well, we would have hoped for it to be in Cairo or Saudi. In fact, given this is all online, it is in Saudi. We'll claim it's in Saudi. Yvonne and I are both in Saudi Arabia, and we're giving you this presentation to try and outline what's going on. You're going to get 20 minutes from me, 20 minutes from Yvonne. We are building up coverage more and more. We've got a macro report coming out on Saudi Arabia within the next week or so. It's one of the very interesting reform stories. But I'm just going to take you through some of the key things that was striking me. I have to start with the big picture. The big picture, of course, is what has COVID changed? And in my view, the biggest change is the rise in debt levels in the States, from under 110% of GDP in 2019 to over 130% of GDP today. So that's something we've also seen in the UK. We've seen Eurozone debt levels pick up. Everyone's debt levels have picked up, but more in developed markets. And what I think that does, and you may have seen these slides in the report we put out a month ago, Trust in China. What we think that does is ensures that yields stay low on government debt in the West. And the blue line there is Japanese bond yields since 1990. The red line is German bonds, and the green is US Treasuries. US Treasuries a bit higher, it's more of an inflation country, but anchored down by German bonds. German bonds just track in Japan with a 17-year lag. So base case is this low yield does encourage money into US equities, and we've seen that in a huge way, but also then produces an appetite for yield elsewhere. It's already helped drive down emerging market borrowing costs. So emerging markets, mainstream EM countries used to borrow at, 12% 20 years ago, 6% 10 years ago, 4% about a year and a half ago. And at times it's been close to 3.5% in the last few months. And that means that emerging markets can borrow more and borrow more cheaply. The debt burden doesn't get much worse. And that should set us up for some quite supportive investment flow. And of course, all the while supporting an interest in the equity market too, because of those low interest rates. It doesn't save everyone, these low interest rates. One of the themes that we're drawing out in the Trust in China report was which countries have borrowed too much externally relative to their export base. And Lebanon already in default, as you can see from this chart on the left-hand side. But others, Saudi Arabia on the far right there, just doesn't look like it's got any significant problem. Iraq, the same thing, very low external debt to exports. So no great issue for the Gulf countries. What we do have is more of an issue in sub-Sahara, and that's partly because the export manufacturing base hasn't developed as much as the rise in external debt has. So we've already got Ethiopia, which is the second one on that chart, in default. Honestly, this is about MENA. I'm not drifting too far afield, because I would mention Egypt, where the debt ratio is looking worse than 10 years ago. We are nearly, 350, 400% of exports is external debt. But what we think is going to happen is you're going to see an industrialization theme. Egypt and Morocco in North Africa, in fact, all of North Africa and the Gulf have the literacy, the education needed to industrialize. Obviously, I don't think the Gulf is going to be an industrializing story in the same way that North Africa is, but the education's there, and importantly, the electricity's there too. So the green is where you've got enough electricity to industrialize. Now, anyone who's been listening to me about Egypt knows I've been banging on about this for about 3 or 4 years already. And I keep on saying you need 3 years of stability for that manufacturing export investment to start to arrive. Egypt didn't have it in 2017 because of the devaluation, didn't have it in 2018 because of I think a sell-off in Turkey, but triggering concerns that Egypt might do so as well. It didn't, in fact, but people were concerned. 2019 was looking good. I reckon 2020 could have been the year we started to get the manufacturing FDI, but COVID. And that's probably now off the agenda in 2021. And maybe not too much in 2022 either. So it's only pushed back the manufacturing story, unfortunately, for Egypt. But for Morocco, where it had already been in place for a good 10 years, the story's good and improving. Commodities. Okay, so we've got this massive rise in commodities at the moment. I think the biggest driver is Chinese GDP growth. The blue column there is dollar GDP increase, which when it goes up a lot, you tend to see commodities do very well. And when it crashes back down again, you have a problem, as we had in 2016, for example. What we're seeing this year, assuming the currency is around 6.4, 6.5 to the dollar, is the biggest increase in Chinese dollar GDP that they've ever had. And next year is also going to be extremely strong, assuming we say it's 6.4 to the dollar. So this is really helpful for commodities, particularly the metal space where there just hasn't been much supply investment. For oil, Alex Bagansky is looking for around the 60s for the oil price. And that's roughly consistent, actually, with what we've had on average, if we were to average out the oil price in today's money, since about 1970. It's been about a similar number. It tends not to sit in the average. It tends to either be too low, as we saw in the 1980s, or way higher, as we saw for 10-year periods in 74 to 84, and again from 04 to 14. I'm not sure we're going to see another boom time for oil because of the carbon emissions story, and you probably saw the report out today talking about very low oil prices on the back of this carbon emission need to get to zero on carbon emissions. What I'm showing you here is annual carbon emissions since 1970, and the point to focus on is that number has to be not just down, but that has to be zero. Actually, ideally negative. And it's not going to happen quickly enough to stop an increase in global temperatures. Now, I haven't done enough work on how each of the Gulf countries are going to have to deal with their carbon emissions. The numbers in Qatar, we're talking 39 tons per capita of carbon emissions. Now, luckily, there's not very many capita in Qatar, so that's less of a concern than the numbers out of Kuwait, Bahrain, UAE, and Saudi. And all of them are producing much, much more in the way of carbon emissions than say, Russia, or another oil exporter like Norway on the right-hand side. And then we've got the low carbon stories as well. The Moroccos and Egypt, which seem to be in competition with each other to make the biggest solar power plant certainly in the continent right at the moment. But that issue of the Gulf countries isn't just explained, by the way, by their level of exports per capita of oil. That's not how the calculation works. So Kuwait and Qatar do export a lot of oil per capita. You see that on the left. This is barrels of oil per 1,000 people. But Norway's third highest and doesn't have anywhere near the emissions of these other countries. It's got a lot of hydroelectric, which helps. Anyway, I haven't done enough work on this. We will be doing more work on this, given the spate of numbers coming out from various countries. But the point is that I don't think we're not seeing oil going to $80, $90, $100. We think there's enough shale capacity, there's enough spare capacity in Saudi and so on to keep that roughly where it is, even as metal prices do stay high. Euro dollar, I think, is the hardest thing to forecast. We're looking for gentle weakness in the dollar. I don't know if that's really going to impact badly on investors in the Gulf, which of course mostly dollar pegged. but we're looking for gentle weakness, a few percent a year. I think it'll pick up from 2022 because the change in the rhetoric about trade wars means foreign direct investors who've been coming to America from 2015 actually to 2020 will start to say, where can we start to invest more cheaply? And they're going to look around the world and they'll say the minimum wage in America is what, $1,200 on the left-hand side there per month. Biden wants to push it to $2,500. McDonald's did that on Monday, I think. And you can choose instead to look at an Egypt, 3/4 of the way across that chart, where it's $127. I'm going up in the budget on the 1st of July, but very, very much cheaper. Morocco looks pretty good here as well. Jordan, which also comes out badly on that external debt ratio chart I showed you. Jordan's looking too expensive. And I had a side meeting in the capital a couple of years back, and they confirmed that they are losing jobs to Egypt because it's more competitive on the manufacturing story. Currencies, right. Emerging markets, there's kind of two stories I just want to focus on here. One is Egypt, which is about 5th from the top here. It's about 14% overvalued on my London model. Yvonne's got a slightly different model, but we're roughly in alignment. Around 18 to the dollar is fair value, and 15.7 is a bit too expensive, but really well supported by those interest rates. If you look at the right-hand side, 1-year interest rates are what, 13%. And you've got a central bank determined to keep inflation down, the currency stable, foreign investors sticking with the T-bill market, with the bond market, and it is providing stability, but at the expense of a slightly expensive currency. The others, Saudi, Qatar, UAE, they roughly in a 5% cheap to 10% overvalued based on our real effective exchange rate. So it's just telling you that inflation here has been a bit higher in most of these countries than in the key the key trading nations. What usually happens is that adjusts via inflation. There hasn't been a deval in Saudi, I think, since 1983, and even then it was only a few percent when oil did that massive crash that I was showing you earlier. And what we can see here is that roughly zero, for one country, I think it's 2% of the time, the currencies have either got 20% too strong or more than 20% too cheap. But it doesn't happen because they tend to adjust via deflation when needed to get the currencies back to fair value. Egypt, what does this tell us about Egypt? It tells us that over a third of the time in the last 25 years, the currency is between 5 and 20% overvalued. So it could stay here for another few years. There's no reason particularly to assume any short-term sell-off. I'm just showing you very briefly Morocco. It's exactly in the middle. It's exactly fair value. And once the tourists return, I don't think there's any reason to assume that it should be anything other than fair value. So I'm not going to focus on that too much. Last thing I wanted to go on about, because I always do in the last 2 years, is this fertility stuff. So this is a little map of fertility, and green is good, as it was with electricity and literacy, 2 to 3 kids per woman. And Egypt is getting close to that. Now, what I was quite interested in was, what does that mean? And what it means is that once you start to get your fertility rate down to 2 to 3 kids per woman, your bank deposits tend to rise because you've finally got some money left over at the end of the month because you haven't spent it on your hordes of children. And Egypt's quite interesting. I don't know if you can pinpoint it on this graph, but Egypt's actually got one of the highest rates of deposits of any country with its fertility rate. In fact, the highest. And I found out why the other week. It's because Egypt has been hovering around this 3 kids per woman level for about 15 years already. And as we said, as you get the fertility rate down, your savings go up. So I think the reason the banks do have a lot of cash to invest and one day to lend to the economy, and I think it's because of this. I think it's because the fertility rates being quite low. Which country is looking worst on fertility rates? Well, it's Yemen, which is in all sorts of trouble. Iraq is still surprisingly high, but pretty well everybody else is well below 3. And what I think is quite interesting is how many of these countries have slashed that fertility rate in just 10 years, which I hope some countries in sub-Sahara will be able to note and perhaps copy. We're having a client conversation just the other day about what's the ideal demographic kind of situation for a country. And he was arguing that actually when you stopped having kids and there's a lot of people in the working age all out there working and earning money and saving money and so on, that's ideal. A bit like China today. And about 65% of Chinese are now working age population. And you can see the numbers here for the Gulf, it's even higher. The numbers are really distorted by immigrants, but you can see that Qatar, UAE, we're talking 4/5 of the population are working age. And I've put in some forecasts for 2040 from the UN, but I mean, take those with a bit of pinch of salt. What I would draw your attention to is the numbers will continue to pick up for an Egypt or Morocco, and you're going to have a rising share of the total population, which will be out there consuming and wanting more goods. I've got a few slides here from Dan, and then I'll be finished in about 3 minutes and we'll hand over to Yvonne. What about equity market valuations? Where are we at? We've got Morocco, as you know, very expensive because they've got a very large pension fund, mutual fund industry, which is mostly constrained within the country. All the grey countries there are countries where the PE today is actually above its 10-year average. And that includes most of the Gulf guys. But down at the far right, you've got Egypt and a number of other countries in red, but Egypt's the one which you might be interested in, which is looking particularly cheap relative to its 10-year average. And a key reason for this is, we think, the relative attraction of yields, equity yields, dividend yields versus interest rates. If I'm an Egyptian and I can get my 1-year interest rate, which I think we're looking at 13% or something on our exchange rate chart, I'm going to do that rather than own equities. And in fact, both Egypt and Tunisia, you get more money from being in fixed income or 1-year deposits than you do in equity yield. But on the left-hand side, it's a different story. And so for the Gulf countries, the retail investor bid is very big because they are literally making more money. And you see that on these two graphs, which Artyom has put together for us. Dividend yield on the right-hand side versus 1-year deposit, and it's just more attractive in the Gulf. So it's been locals who've been supporting that market and keeping it expensive. Not foreigners. This is another of Dan's charts. What he's showing you is the index weight on the left-hand scale. So take Saudi, which is what? I managed to get, there we go. It's about 1/8 along. It's 2.5% of the index, and only 20% or so of foreign investors, portfolio investors, have actually got any exposure to Saudi at all. So most funds are not looking at it. And in fact, quite a number of our smaller markets, Egypt, less than 20% of funds have got exposure, but partly because it's so very, very small. So there is possibility, maybe if oil prices head higher, if the dollar stays strong or whatever, that we could start to see that a bit of appetite come in from the foreigners. And it's worth being aware that taken together now, the Gulf countries, the 4 Gulf countries in the EM, Kuwait, Qatar, UAE, and Saudi, are now bigger than South Africa and Russia, but relatively under-owned. Big picture risks out there. This is the same for any presentation I'd give you. It's excess liquidity, it's China crashing, it's miscalculation or People's Bank of China, which is the one I'm now much more worried about, given that China's been driving our global growth for so long. But big picture here is that we assume US yields are going to stay low through the 2020s. Yes, I'm worrying about that this first half of this year, but that's our base case. That is, or has already pushed US equity valuations higher. Dan's just put out a fantastic report today saying that EM is at a 31% discount to developed market valuations. And it's only been this cheap 6% of the time in the last 10 years. So we obviously we're a sell-side bank. We obviously are looking for reasons to be a bit more bullish, but the numbers do seem quite supportive. We're looking for gentle dollar weakness. We're looking for oil to stay roughly where it is, rather than metal prices. And the Gulf is giving us that currency peg story. Do look out for the Saudi report coming out from Andre next week. I've gone through it. It's a 20-page tome looking at everything that's been going on and some of the very exciting reforms. But at this point, I'm going to stop and hand over to Yvonne. And I do promise to stop sharing, Yvonne.
All right. Thank you, Charlie. Let me start sharing my presentation before I start speaking. Hello, everybody. Thanks for joining our MENA conference. I'll be speaking to you about our outlook on the macro side for Egypt and Morocco specifically. I'll be starting off with Egypt, which we think had a relatively good crisis, if you can call it that, in 2020. And by that, I mean there's among a minority of countries that grew during last year's crisis. If you look at this particular chart, you see that there was a contraction in growth in the second quarter of around 1.7%. But thereafter, we did see growth resume, and it has picked up since then, suggesting that we are going to see a sustained recovery into 2021. If we just draw deeper and just look at how the various sectors performed and why there was growth, I think the main thing to point out was that consumption was actually pretty resilient. The household consumption was resilient during the crisis, and that helped offset the slowdown that we saw in tourism and investment. If you look at this particular chart, we show the contribution of the various economic sectors in Egypt to GDP growth. And you will see that most of the sectors, those on the top half of the chart, grew. Only a handful of sectors declined in the case of Egypt, and that was mainly manufacturing, as we see there, as well as tourism. But as I mentioned, most of the economy grew, and that's why we ended up seeing Egypt grow by around 1.5% in 2020. This year, we expect growth to pick up to 4.2%, and we expect that to be led by recoveries in the transport sector, agriculture, health, and education. If we look at tourism, which, as you saw in the earlier chart, was the second worst performing sector in Egypt in 2020, I just show you here arrival of passengers at the airports, just to give you an indication, a visual indication of how poorly the sector did. Tourism declined by around 50% in 2020, and that's as compared to growth of 8% a year earlier. And that corresponds with that fall in passengers, around 2/3 fall in passenger traffic at Egypt's airports in 2020 to 13.3%. If you fast forward to the beginning of this year, you can certainly see that there is a recovery. If you focus on the grey line, that shows you that the negative growth in terms of passenger traffic got a lot smaller in the first quarter of this year. And we're expecting, when the second quarter numbers come through, to see a return to positive growth in passenger traffic, given the low base from last year, and for that growth number to surge. So certainly you're seeing a pickup and recovery in the tourism sector, which should support the growth outlook for 2021. Moving along to inflation. Last year, inflation remained relatively contained in the mid-single digits region. We have since seen moderation or slowdown. Inflation is currently sitting at 4.1%. That's as of April, compared to 6.2% a year earlier. And that's mainly due to a slowdown in non-food inflation that we attribute to the easing of restrictions and less supply disruptions. If we consider the outlook, we expect inflation to average around 4.7% this year. We do think there's upside risk to inflation, and that's in part due to a strengthening commodity prices, and particularly energy prices. That may result in some uptick in inflation, but other than that, we do expect inflation to broadly remain in the mid-single digits region. We move along to inflation. As you recall, last year, the central bank responded to the crisis by cutting the policy rate by 350 basis points, and that was to support growth. In terms of our outlook this year, we're expecting no change in the policy rate. We don't expect them to cut the policy rate, even though inflation as it sits today seems to be relatively subdued. Some of the reasons we don't expect any cuts is because we think the risk for inflation is to the upside, as I mentioned earlier. The currency is overvalued. I'll speak to that shortly. And secondly, as you know, Egypt benefits from this carry trade. So its attractive positive real rates does draw capital inflows that help support that strong currency. So as a result, we don't expect to see any easing. Moving along to the Egyptian pound, as I alluded to earlier, we do estimate or do find the currency to be expensive. On this particular chart, I show you the real effective exchange rate for the pound that we've estimated, showing you the trend from 2006 to date. As you can, or just to explain more on the chart, the grey line shows the FX rate implied by the average over that period. So basically that's the fair value, and as you can see, the real effective exchange rate has become expensive relatively to that implied fair value. Our fair value estimate for the pound is 18 to the dollar, implying that it is around 13% overvalued. As you can imagine, an overvalued currency does imply that it's inclined to depreciate at some point. However, over the short term, we expect it to remain well supported by the capital inflows that we are seeing going into that economy. Moving along to the fiscal situation, as you've seen globally, there's been a significant deterioration in the fiscal balances of several economies. In the case of Egypt, there you see that there has been some widening of the budget deficit. It's estimated to come around to around 8.4% of GDP for the fiscal year that ends in June. Public debt has also picked up on the back of that. The estimate is that it would come out at around 93% of GDP. The upside for Egypt's fiscal situation is that a growth recovery is already underway, as I mentioned earlier. Growth this year we're expecting to come in at around 4.2%. And because of that recovery, the primary balance and surplus, that is expected to return back above 2% of GDP, which implies that you should see the debt trajectory start to moderate or go downward once again as soon as the next fiscal year, which begins in July. So that's one of the positives about Egypt, is that its brisker recovery compared to that of other countries in the region implies that it should be able to see a correction in its fiscal situation sooner than that of other countries. Moving along to Morocco. Morocco had a much more difficult crisis than Egypt. You'll see on this particular chart where we show quarterly growth that the economy contracted by 15% in the second quarter, and it continued to decline during the remainder of the year. So the full year growth number for Morocco was negative 7.1%. What aggravated the crisis, or I guess the COVID pandemic exacerbated the situation in the country. There was already a slowdown in 2019. In particular, the agriculture sector was underperforming due to poor rains. If you look at this particular slide where I show you the contributions of various sectors to the economy, you see that in 2019, agriculture declined, and that was the only sector that declined in 2019. And then it was followed by a second consecutive year of decline. So the recovery this year will be led by the agriculture sector due to better weather. Indeed, the preliminary numbers coming out of Morocco for the first quarter of the year suggest that the economy grew by 0.7%, and that was entirely due to the agriculture sector that showed a sharp recovery to 14% in terms of growth. However, the non-agriculture economy was still in a negative mode, that contracted by negative 1%. So what we're seeing for Morocco is basically an economy that whose recovery will be driven by agriculture in 2021. This particular chart, speaks to the unemployment numbers. There was a pickup last year, jumped to 12.7% in the third quarter from around 9% a year earlier. We've seen that unemployment number rate has persisted. It's still sitting on 12.5% in the first quarter of this year. The concerns around this persistent unemployment rate, or it remains at these levels, is that it may lead to a loss of skills for those that remain out of the job market for an extended period, and that could reduce the country's output potential going forward. On this particular chart, I show the contributions of the various expenditures to growth. So first, earlier I'd shown you what the various productive sectors contributed to growth. So this is the expenditure side. Here I'd just like to highlight how poorly consumption did. As you can see, that was the biggest detractor from growth in 2020, as well as gross capital formation, which was investment. The only sector that really had some sort of growth was the government, and that's as it picked up the slack from the private sector. Net exports also came in slightly positive, and that's mainly because the fall in imports was deeper than that of exports. This particular slide, I think, suggests that the vaccination rollout suggests that there are some tailwinds for Morocco, in particular that they've been a lot faster at vaccinating their population. You see here that at 13th of May, 16% of its population had been vaccinated. That's much better than the world average of around 9%. And Egypt falls just under 2% in terms of the share of its population that is vaccinated. So that suggests that Morocco should be able to open up its economy sooner than other economies in the region, which is positive for its tourism sector. Moving along to inflation and interest rate, we did see inflation fall rather sharply. It went to negative territory last year, negative 0.7% in June, and I think that's a reflection of the collapse in demand. The central bank did respond to the crisis by cutting the policy rate by 75 basis points to 1.5%. We do think there's scope for further rate cuts this year, given that inflation remains subdued. The most recent inflation number is 0.1%, I think it was, for March, so very lows. And in terms of the medium-term outlook, we only see it increasing to around 2%. So given the weakness of the economy and how soft inflation is, we think there is scope for further rate cuts there. On the currency side, the Morocco dirham we like, mainly because it trades close to its fair value, which implies limited volatility. It's just very slightly undervalued, 4% undervalued. And in terms of its fair value, it's a fair value estimate that's around 8.64 to the dollar. So a currency that we do like because it trades close to its fair value. Moving along to the fiscal picture, similar to what we've seen in several countries, that deterioration in 2020, a budget deficit of 7.6% of GDP, and that led to that jump in the debt number, 76% of GDP in 2020. In the case of Morocco, given how weak its recovery is likely to be, as we mentioned earlier, the fiscal consolidation is likely to be gradual. The IMF recommends that they only embark on fiscal consolidation once the recovery has solidified. And the estimates are that they should be able to bring down that debt ratio below 70% by around 2025. The upsides for Morocco on the fiscal side is that it does have low interest rates. The maturity on its debt is of long maturity, and the country does have lots of domestic savings. So that gives it room for temporary higher level of debt. And just to conclude, I'll just highlight the main points that I went through during the presentation. On Egypt, we expect that sustained, that pickup in growth we saw in the second half of last year to be sustained this year. We're looking for 4.2% growth. We think there's a low probability of further rate cuts in 2021. We'll find the currency to be expensive, but we think it's well supported, at least in the short term, in part due to those capital inflows we mentioned. The recovery will allow for a return to a downward trajectory for debt from the next fiscal year, is our view. And in terms of risks, those include an uncertain global recovery as well as changes in financial conditions for emerging markets. On Morocco, we think the brisk rollout of vaccines is positive for the recovery. We expect weak growth in the non-agriculture economy. We think there's scope for further monetary easing to support credit growth, and we expect fiscal consolidation to be gradual. The risk to Morocco's outlook is a weaker than projected recovery in its key export market, and that's the EU. That's it from me today. Thank you for your time.
Yvonne, I know we're not going to do Q&A at this point, but if you had to make a bet on when, so this is just me being difficult now, putting you on the spot, but if you had to make a bet on when the Central Bank of Egypt might cut rates, or maybe it's not even rate cuts that matter, maybe it's just falling yields in the market, which, potentially the CBE is keeping well supported. At what point do you think the market might see that decline in interest rates? Do you have a thought on that, whether it's a 2022 story and first half, second half?
Well, given that my current view is that the risks to inflation are to the upside, I don't even see that at this stage being, say, a first half of 22 story. I do expect them to keep the policy rate or interest rate flat even into 2022. Just given that our views are that the risk to inflation to the upside. Also, the currency remains expensive. So I think the focus will be on trying to draw those capital inflows, finance the current account deficit, as opposed to trying to boost growth.
Thank you very much. I know that there's already been requests coming in for the presentations. Yvonne and I will both be sending PDF versions to sales to forward to you. So just get in contact with the salespeople and it will be in your inbox very soon. What we've got next, but there's going to be a little 15-20 minute break first, is Dan Salter is giving a presentation and has a panel to talk about certain companies. And so we're looking forward to that at 2:00 UK time in about 20 minutes time. So see you then, and hope to see you again soon. Take care. Bye.